When things get tough in the real estate market, we start to see more and more creative financing deals start to happen. When interest rates are high and things have shifted, it's harder to get mortgages. We see people seeking alternative options to actually make deals happen, because the reality is, even though interest rates are high, or even though the market has shifted in a way, people still need to make moves, and they just need to find a way that makes it happen within their budget and their desired terms. And so today we are going to break down the difference between two creative financing options: the seller carryback and subject to financing. Hey guys, I'm Andrew Lewis, real estate investor and entrepreneur with over 10 years experience building and growing a real estate team and investing in real estate. Before we get into today's video, take a moment, hit that like button for me, leave a comment below with any questions you might have about creative finance, and don't forget to hit that subscribe button so you don't miss out on future videos. I'm here to help you break out of the 9-to-5, gain financial freedom, and grow wealth through real estate. So when it comes to creative finance, I hear misconceptions about two popular finance options, which are seller carryback and subject to financing. Most people think that those are the same. Today, I want to break down the differences for you, explain exactly what scenarios you would look to use those in. So let's dive in. Let's start with seller carryback financing. This one, in a nutshell, is essentially when the seller of a property acts as the actual lender for that specific property as well. So they become the lender, they issue the loan and terms and all of that to the buyer. It allows a buyer to buy a property without actually having to run their credit, submit all the documents to a lender, get the lender funded, all of those pieces. It basically just allows the seller to act as the lender, issue a loan, and then transfer title. So let's break down some important details about seller carryback financing. Key point number one here is that the seller is the actual lender in this transaction. So what does that mean? That means if you are a seller offering this out, you need to own this home outright. You can't have a loan on your property and then offer a loan out to somebody else because you don't actually have the funds for that, and there's already a mortgage recorded on that property. So you need to own this home outright to be able to offer these kinds of terms, because you now become the lender and the buyer becomes the borrower. Point number two is the terms of the financing are totally up to the seller and the buyer. So this is some extra negotiation that happens. Typically, when you're buying a property with a lender, that's already handled beforehand, and there's no back and forth between buyer and seller about these terms. But when the seller becomes the lender and the buyer becomes the borrower, there's more to negotiate. So we're talking interest terms, repayment period for the loan. Is there a balloon payment due at the end? How long is that actually going to run for before that is due? All of those terms can be negotiated, and that can actually help with negotiating on price and some of those other things, because when there's more points than just the price to negotiate on, it actually allows some flexibility, kind of like you would get at a car dealership where you're trying to get a payment within a certain range, and they can adjust certain things to get you to that payment, and you can accomplish that the same here with seller carryback. Number three, the buyer provides a down payment. So if you're going into this scenario, chances are you're still gonna have to come in with some cash. So this doesn't mean you're coming in with zero down. You're probably gonna need to offer a decent little down payment, put some skin in the game for a seller to be willing to work with you on this. So you'll put some money down, and then the seller will finance the rest for you. Number four is the title for the property is actually transferred to the buyer/borrower. So this isn't some instance where the seller is providing the financing and they're still holding onto the title. You actually get the title as the buyer. The seller is simply providing that financing with the terms that you've agreed to, and you get to take possession and actually move into the property and own it, just as if you took out a traditional loan. And lastly, just in case of default, if the buyer stops making payments on this, the seller does have the right to foreclose, or that should be written into those terms to make sure the seller has the right to foreclose on the property and take possession if the buyer defaults on the loan. All of that would be laid out in your loan contract and on the trust deed, so you should have all that information ahead of time, but this is gonna work very similar to a traditional loan in terms of foreclosure in case of default. So real quick, let's break down some pros and cons here of seller carryback financing. The pros are, number one, oftentimes a buyer doesn't actually have to run their credit or put anything on their actual credit report as far as taking out this loan. Most often this is simply done with some paperwork, and so it's not something that's going to take away from your credit going forward. Number two, this provides flexibility for the buyer as far as negotiations go. On the seller side, this means that the seller can often ask for typically a higher price than what it's normally worth because they actually get to dictate all of those terms as well. So there's many more variables to it, and it's got pros and cons to both the buyer and the seller. And the cons for this one, first of all, the loan has to be paid off. You have to find a seller that owns this property free and clear or has the ability to pay it off. There are some scenarios where, maybe they owe $200,000 and you are going to give them a $200,000 down payment, which would allow them to pay off their loan, and then they could carry the rest. But most often you're going to have to find a seller that owns the house outright in order to make this happen. And another con, this one typically falls to a seller, but in this case, you've lost some of the liquidity of your cash. It's now tied up in something. You cannot recall that loan outside of those terms. So yes, you may be getting more money for the property in the long run, collecting interest, all of those things, but you're not able to just tap into that money right away and get that fast repayment. So you're going to have to look and live out the actual life of the loan before you get all of your money back. As a last quick note on seller carryback financing, I do want to say most often you're not going to find some seller that is going to finance a property for you for 30 years at a fixed rate and everything's just gonna be great. You're gonna pay them off over that long period. The reality is they're gonna want their money back faster, and they're usually using this as a band-aid to help you get through something. So a lot of times on these seller carryback deals, you are going to find a shorter term, so call it 3, 5, 7, 10 years, somewhere in that range, with a balloon payment due at the end of that period. So don't let that scare you. That doesn't necessarily mean that there's a balloon payment due and what am I gonna do when that comes due? They're gonna ask for the remainder of the loan to become due at the end of that term, and all that's doing for you is then forcing you to go out and do a refinance to take the financing out of their name so that they get fully paid off on the property, they can move on, and then you're working with a traditional lender or another private or hard money lender or something like that. So keep in mind, it's not gonna be typically 30 years that you're finding on these deals. Next up, let's talk subject to. This is a fun form of financing here because in reality, all that you are doing is coming in and taking over the current owner's existing mortgage. So this is not assuming a mortgage. That's a common misconception, but what you're doing is taking over the payments, keeping them actually in the seller's name, taking over those payments, taking possession of the property as well as the title, and moving into the property. Let's break down some of the details. Number one, the buyer purchases the property and assumes responsibility for future payments. So you will still come up with a purchase price for the property, and typically here you're going to pay the difference between what the price is and what the seller owes on that property. You'll pay that difference in cash or sometimes even over time through some payments to the owner of the property, but then you will take over the current existing mortgage payments, again, still in the seller's name. Number two, again, because you're taking over those payments, keep in mind that the seller's existing mortgage is not paid off, refinanced, anything there. You are simply keeping it in the seller's name and continuing to make those payments typically through a loan servicer. So you will make payments to a servicer who will then take that money and make a payment on behalf of the owner. So there's kind of a middleman involved here to make sure that that payment gets made and make sure that both parties are abiding by the contract. Number three, because you are simply taking over payments on their loan as a buyer, you don't need to qualify for anything. You could have zero credit, zero money in the bank. Obviously, a seller is going to ask for some sort of proof that you can actually make these payments, but you're not going to be running a credit report, typically not having to provide proof of income, any of those things. So if you're in a special scenario for whatever reason, credit issues, no credit, any of those pieces, this may actually be a help for you. And lastly, if the buyer defaults on those payments, typically the seller will have a reconveyance deed already drawn up, basically saying that if you default on these payments, the property will revert back to the seller. But keep in mind, Mr. Seller, that if the payments are late, that falls on your credit. So there are some risks involved. Yes, you may get the property back with a lower balance on your loan, which is pretty awesome, but keep in mind that any late payments on those are going to ding your credit and affect you. So let's break down some pros and cons of subject to financing. The pros, I already mentioned, you don't have to run credit as a buyer. You're not having to qualify for a loan. So if you're in between jobs, you're independent contractor with less than 2 years of work history, you own a business, whatever that may be, this is a scenario for you that allows you to get into a property without actually traditionally qualifying for it. Pro number two, as a buyer, you're typically not going to be bringing a whole lot of money to this deal either. So commonly, these types of transactions are done with somebody that has little to no equity in a property, maybe even upside down on something. So when you find that person, you are usually only having to pay the difference between what you agree to price-wise and what they actually owe on the property. If they just bought it last year and their job changed and they need to move out of the property quickly and they're really tight on equity, this is something that you can take over. And again, you're not gonna have to put down a traditional 20-25%, especially if you're on the investor side. So advantage, less money out of the buyer's pocket. Next up, cons. Number one is that loan stays in the seller's name and there is a ton of risk there. So make sure that you weigh this out, especially if you're on the selling side of it. But keep in mind that if your buyer defaults, you may get to take the property back and have a lower balance on your loan because they paid it for however many years, yet it could be affecting your credit. Con number two is the debt stays in the seller's name. That's a pro for the buyer, but a con for the seller. The debt stays in your name. So if you're doing this subject to financing and you go to buy another property and the lender runs your credit, they're going to see this house on there still, and you're not able to simply say, well, somebody else is making the payments for me. So you're going to still have this on your credit. It's going to affect your ability to purchase things in the future unless you've just got a ton more income on things. So weigh those options out before you jump into a subject to deal. So what are some good instances where you might use subject to financing? Again, you're going to be looking for somebody that has little to no equity in that property, because that's typically when, if they're talking to a traditional realtor, selling it the traditional way, they could be upside down on some things. So subject to can solve that problem for some people. There are softwares out there that you can use to find these deals. Property Radar is a great one. You're basically just looking for somebody that has little to no equity in the property, and you can start just cold calling people, offering them subject to deals, basically saying, I'll come in, take over those payments. A servicer is going to ensure that I make the payments and pay the loan balance for you, and you basically come up with the deal from there. So typically somebody that's going to be in some sort of financial trouble here with little to no equity within the property. So don't just go thinking that you can find homes on the market, offer subject to deals out there, because again, it's risky for a seller and there has to be some sort of motivation for them to actually make that happen. That's it for our breakdown of seller carryback financing versus subject to financing. Again, the two are very often confused along with loan assumptions. So make sure that you keep an eye on those details, keep them straight, and keep in mind that when you're going after these types of deals, it's not just finding any property that's up for sale and saying, hey, can you carry back the loan? Hey, can we do subject to financing? Most often the answer is going to be no, but that doesn't mean that those deals aren't out there to be had. So imagine the possibilities of taking on somebody's loan subject to their current loan. Imagine going to somebody that has little to no equity on their multi-million-dollar property, telling them, hey, no problem, I can take over that $7,000 a month payment for you, no big deal, and you simply move into that property, take ownership of it, and continue to make those payments for them. So it's worth the squeeze, but you're gonna have to put some work into it to make these kinds of deals happen. And again, don't just run around blasting these terms out to people and seeing what's gonna stick. You have to find the right seller in the right scenario, use these as creative tools that you can use to find deals and avoid traditional finance. So I hope you enjoyed today's content. If you did, do us a favor, hit that like button, leave a comment below about any questions you have, or tell us a story about a time you used creative finance. And don't forget to hit that subscribe button so you don't miss out on future videos. I'm here to help you break out of the 9 to 5, gain financial freedom, and grow wealth through real estate. See you next time.